The financial world is constantly changing, and there are decisions that are made, and these decisions get a lot of press. And this most recent Fed meeting was no different. There's been a lot of people postulating and hypothesizing, okay, is this good? Is this bad? What does it mean? Was it the right call? And so we hope that we can put a little bit of logic and calm-headedness to what's going out there in the financial world.
I mean, I like to think that we are your source for what to do with that next dollar. There's a reason we have the financial order of operations. So when big financial stuff happens, whether it's tax legislation or now the Federal Reserve changing their stance on interest rates, we want to kind of cut through the stuff because you're trying to figure out, well, what does this mean? But I want to, before we jump into what this means for your wallet, we want to give you some context.
Sure.
Because I think what a lot of the posturing that is going on is people know that the Federal Reserve has a tricky job ahead of them, Bo. And we decided we would kind of share, inflation is one of those things where you keep hearing that coming up. So we were like, let's go ahead and just show everybody. What is everybody saying about CPI? And he said, we have at least come off the mountain. I mean, because look at what this thing looked like from the spikes of late 2020 all the way to 2023 is where we built that mountain. It was kind of scary.
It was, but we're still above the target. The Federal Open Market Committee has said, hey, we have this target of 2% inflation, and we're still slightly above that. And over the past couple months, we have seen a slight tick up. You've already mentioned it's not to the levels that it was back immediately post-pandemic, but it is starting to turn up. And so there is some concern, okay, is inflation a problem? Is that something we need to address? Is that something we need to be aware of? But that's not the only problem that they're facing.
Yeah, the other thing I keep hearing the news media talk about is the job market. And if you look at this, it is a little concerning. We're not as white hot with people getting new jobs and opportunities being out there. Unemployment's actually ticking up to a degree. I've seen some anecdotal stuff where people have posted headlines of how many search queries are going on about foreclosures and other things. So there's definitely some concerning things making you say, hey, this is a little concerning. Is the market softer than maybe we had hoped in a lot of ways?
No, look, none of this stuff in and of itself like signals like, disaster, recession. And in fact, GDP growth is still expected to be around 1.6% this year. So still positive economic growth. However, there is a unique problem that's going on. The tricky part is that even though both of these problems exist, the solution is not incredibly crystal clear. Because if you think about it, okay, we have this problem of inflation and it looks like it could potentially be ticking up. So what is one possible solution, one way to combat that? Well, we could increase rates. We could raise interest rates, and that would serve to stave off inflation. Okay, got it, check. But what about this other problem? We have this job market problem where jobs are slowing down and unemployment is slowly starting to tick up. Okay, how do we combat that? Well, we decrease interest rates. Okay, well, so in order to solve one problem, we have to do X, but in order to try to solve the other problem, we have to do Y. It's a tricky little conundrum that they're trying to figure out how to navigate.
Well, the thing nobody wants to say out loud because we really haven't faced anything. You hear it from time to time. They throw the word out, but really since President Carter, the fellow Georgia boy, stagflation. Because this is one of those things where when you have inflation, but you have an economy that might not be doing as well as hoped, you're like, oh my gosh, well, how do you get yourself out of this? Because the solutions are not as easy when you reach those type of moments. Now, so there's to be determined, and we don't have all the answers for you. We just want to kind of lay out for you. But here we can tell you what the Federal Reserve has actually said and what they did from the meeting. And what they ended up coming out with is that they cut rates by 0.25%. And they even gave guidance that there's potential for 2 more rate cuts by year end.
Yep.
Now, that's not a guarantee. There's a good chance that as data comes in, they will change or posture to go in a completely different way. But it is something that we're like, hey, now that the Fed has voted to lower interest rates, what does this mean for you? How do you plan for this? Because there's a lot of big things that you're probably trying to navigate.
Yeah, a lot of people are asking, okay, it happened last week. What's that mean? And the answer is not a whole lot just yet. Because here's what we do know. We do know that massive changes are not coming. We're not saying that, hey, we're going to have these huge drops or these huge raises. So it doesn't look like that's what's going to happen, even though they've sort of hinted that, okay, we could potentially see some additional rate cuts. Even that is not set in stone. So when you think about your personal finances, when you think about the decisions that you make related to some of the policy changes that come through, we want you to think about the different areas that this could affect. And the first would be investing. So Brian, when you think about, all right, Federal Reserve just said they're going to cut rates and potentially there could be additional rate cuts. And generally speaking, when rates get cut, the market goes up, but there wasn't like this huge thing that happened last week. What does that mean for the everyday investor? How should they change their behavior?
Well, historically, look, investors love when interest rates go lower because the cost of business gets cheaper. You see more people use leverage to invest. You see people, the stock market typically, it's like almost like a steroid for investing. We got a little too addicted to that in the past. I think we're going to be a little more measured about, the interest rates and using it as a sweetener or a juicer for the investing. But right now, I think it's one of those things where I don't know that it really changes the direction or the headwinds that much. It's more about it's back to what does your behavior do? Because we're still big fans of, can you automate the process? Can you make sure you just strip out this noise around you and always focus on having an always be buying type mentality? And then just know that what you need money to do for you is a tool, and not let this be something that you feel like you're market timing or reacting to the headlines, because that's not actually going to help you be successful with your investment process.
Yeah, you want to be very careful letting forces outside of your control end up controlling your behavior. So focus on the things that you can control. You already said it. Automate, always be buying, have a plan in place and stick to that plan. So that's what you should do from an investing standpoint. But another big thing that's getting a lot of publicity right now is, okay, now that rates have been cut, now that rates are coming down and potentially they could come down even further, what does this mean for housing? Because housing in this country right now has been a big problem for a number of Americans. So is this drop and potential future drops going to be a boon for housing?
So now this is, first of all, I got to make sure I clarify this, because it's something it can get easy to get confused, is the fact that what the Federal Reserve, the rates that they cut, don't impact actual housing.
Not directly.
It's because it's impacting your credit cards, your car loans, all those short-term interest rate type things. But even with that said, they're all interconnected. It's like a relative. So, because the housing uses the 10-year Treasury rate here's some good news, because I love sharing good news. Interest rates for mortgages are at a 3-year low right now. I think the headline I saw from CBS was 6.1%, somewhere around there. 6.1 was the average. So that's a positive, but it is one of those things where you just pay attention to what's going on, and because markets are always forward looking. So this means that since you see interest rates coming down, even on the long-term rates, it means a lot of people out there, or a lot of investors, are kind of pontificating that this is a trend that will probably continue. We'll start seeing lower interest rates, and the market's trying to get ahead of that.
But if you are someone who's in the market to buy a home, we would say that buying a home should be more of a life decision and less of a market timing decision. Certainly you want to pay attention to rates, and you want to pay attention to inventory. You want to pay attention to what's going on in prices. But at the end of the day, buying a house should be because it makes sense for your life and your life circumstance, not because, rates just got cut 0.25%. Now it's my time to move. And so if you are someone who wants to know about what you should think through when it comes time to buy a house, go to moneyguy.com/resources. Make sure you check out our home buying checklist. You can check out the home buying affordability calculator to make sure that you're making that decision well. So that's kind of the first piece, people that want to buy. But now, Brian, there are a lot of people that are thinking, man, okay, with the rates coming down, does this mean that I need to refinance? You said it's a 3-year low in terms of mortgage rates right now. If I'm someone who got a mortgage a year, 2, 3 years ago, is now when I need to go ahead and rush to pull the trigger to refi?
Well, I mean, personal finance is very personal, but what I would kind of take into account is the mortgage rate 1% lower than what I got. And if it is, I would start, crank up the spreadsheet, whip out the calculator, and start figuring out how does this pertain to me. And I'd even probably go on our website, moneyguy.com, go look at our resources, go look at search our archives. We've done a lot of content on refinancing, and maybe even you consider before you do refinancing, rate modifications, other things. I'm going to give you the terminology so you can have a great place to start your research, but this is something that there potentially could be some opportunities for you.
All right, so we've talked about what rate cuts could mean for investors. We've talked about what it could be for home buyers or homeowners. But then there is sort of a third group of people that falling interest rates could have an impact on, and we've just kind of dubbed these savers. What does this mean, Brian, for our savings accounts?
Well, I'm going to give you kind of a behind the curtain. I'm just giving you my thoughts on this, is that I think that once again, the Federal Reserve and as well as the market in general are trying to figure out how you navigate interest rates on savings for the long term. Because realize we went for over a decade where you made absolutely nothing on safe investments or perceived safe investments like your cash and cash equivalents. So what did that mean for older investors? It meant that you had to go out on the risk spectrum. You had to go put your money to work to actually get any yield whatsoever.
Yep.
I think when people, because realize we did this, like I said, for over a decade. So I think everybody was worried, hey, whenever we flip the switch to go back to higher interest rates, what is that going to do to the markets? Because we've been essentially taking this drug of steroids for the economy for so long. They flipped the switch, and fortunately, the whole thing just didn't implode upon itself like a lot of people were nervous. So I think now that we've kind of come to the other side where we're now at these high interest rates from a historical standpoint, the market's probably thinking, hey, there's a balance here that it would be nice for older investors to just like traditionally and historically to be able to get 2, 3, 4% just on their cash equivalents, a risk-free rate of return. Let's not go back to zero like we were, but how do you navigate that because there's a balance here. Older investors need to get something without having to take risk, but yet if you keep interest rates too high, younger investors who are trying to buy stuff through debt, like, houses, cars, and everything else, they're paying a higher premium on this. So you can now quickly see where the rubber meets the road on how does the economy navigate this. So I think that my prediction is, or my thoughts are, we're going to see some continued pressure down with interest rates, but we're not going back to where we were. If you think that we're going back to 3% mortgage rates, or you think that we're going back to where you're making 1/4% on your savings account, I just don't see that.
It seems unlikely.
I think because we passed that threshold where we were able to turn interest rates back on and it didn't completely implode the system. Why would they want to go back? I know, yes, it would be great in the short term to juice the returns, but it would not be great for the long-term viability of things. So
I think the big takeaway we would have you take away from this meeting last week is that when you have a financial plan in place, a really good financial plan should be good before economic circumstances change. It should be good during economic changing circumstances, and it should be good after. That's why we don't think that there should be a lot of knee-jerk reactions from you as an investor, as a homeowner, or as a saver. But we do want you to be mindful of it. Are there things that you ought to be doing or ought to be changing? Should you be automating, increasing your saving, buying more consistently, refinancing the house, beefing up your emergency fund, moving it to high yield? These are all things that you can do to optimize your financial life. And that's what we are in the business of doing. We believe that there is a better way to do money, and we show up every single Tuesday at 10 a.m. to help you guys do that.